All right, I think we're good.
All right.
Is it still sharing my
Yeah, disclaimers on.
okay,
You want to start it up?
lost the window. Okay. All right, Ritz. Hey, good morning, good afternoon. How are you guys? I'm just we're gonna give it a few minutes, so let's everyone join up, join in. Bring up my chat stream. I'll try to do the chat on the Zoom webinar we call it, and then also on YouTube. We'll try to. Hey, what's going on, Ryan? Are we good on the Zoom? You're good? Okay, there it goes. All right, cool. Yeah, you guys can message me here. This will be a pretty laid back session. I just wanted to get into, I'll show you guys a little bit about what I teach in my training. We call this the JRM full access team. That was my full access team that we did training for, but it's the JRM trading model. And I wanted to share with you guys what I call how to add and reduce, or the add and reduce method. This is something I tried to do a visual here on Bloomberg, and I'm going to explain this, but if I had to just try to summarize this method in a visual, this is my best effort. I did this on Bloomberg chart, but many years ago. And it'll be pretty laid back. So if you guys have questions, I'll try to hit them as I go. And I want to just share some information, add some value, and then we can talk about the best ways to get involved with us, just a couple of our services if you're interested. And then I'll talk a little bit about the digital asset management firm that we're building. And we also have a trading platform called Rhythm that we're building out and doing an ICO, and we have a white paper and all that good stuff around that. I'll save that for the end also. But before we get into adding and I don't know if you guys heard that was loud. Before we get into adding and reducing, we can get into the charts. I just want to give some background on our trading model. You know, for those of you that might not be familiar, I traded U.S. Treasuries on the institutional side for about 10 years. I ran a couple rates desks. I covered all the big banks, what we call the primary dealers, a lot of hedge fund money, the buy side money management firms. And the reason a lot of traders wanted to talk to us and why they traded with us, we would trade directionally for ourselves, and we took real risk. I mean, I traded between 40 to 60 billion a year, and I mean, I would trade 50 to 25 million, $50 million positions at a clip. We'd take 10 million lots. I'd be on the bid for 200 million. So I know what it's like to trade real risk. I know what it's like to make a market. I know what it's like to lift different bonds and try to cross them and call a customer and trade on two phones in each ear, making markets, filling customers, getting hit and lifted on the screens going down. I used to have Goldman work my orders overnight. I traded in London. I had guys that covered me in the Tokyo session at RBC. So I've looked at a lot of charts. I've been inside of a lot of trades, and this model that we built, a directional model, is probably one of the best out there. And that's why guys like to to work with us and trade with us, because whether they were a prop firm out of Chicago, just trading tens, day trade basis for 10 ticks, or we had longer term accounts that were in charge of the entire bond portfolio at a bank like Bank Leumi. They were just in the news recently in some crypto headlines, but they wanted to know where the yield curve was going. And so this is what we did, and we were good directional guys. So our work is a lot to do with cycles. I kind of like to share some of this history, and I get into this stuff in depth and when you buy the training. But one of my favorite teachers and someone I've studied a lot is a gentleman by the name of Martin Armstrong. A lot of you guys followed him, or are you familiar with his work? He's a fascinating guy. He was thrown in prison on contempt, never had a legitimate trial. He's been one of the biggest traders that's still living. But he studied financial panics over a 224-year period, 1683 to 1907. And what he found was that these crashes and these recessions and these panics started to appear in a cyclical fashion. And what led him to realize was that there's about 8.6 years that this cycle of boom and bust kind of played out. And through his study of that, the global business cycle is on an 8.6 year cycle. And it's about confidence, guys. So at the end of the day, markets really trade based around confidence. They're going to move in anticipation of the fundamentals. They move not based on the news. They move based on rumor. But at the end of the day, it comes down to confidence. So when we start to understand cycles, it's about time and turning points. And then different waves will build into larger waves. So there's a 8.6 year global business cycle I talk about, but there's also an 8.6 year that you can 8.6 frequency as far as on a weekly chart or hourly chart. And so, for example, Bitcoin, this last decline off the high is actually finished on an 8 to 9 week low. And so when you start to kind of see that these cycles exist, it kind of opens up a whole new world to trading. So there's public waves and private waves where confidence kind of swings back and forth like a pendulum between confidence in the public sector, and then it swings back to the private sector. And we're in this private wave right now that will peak into 2032. I've talked a lot about cryptocurrencies is probably, and digital assets is going to be a big part of that. I think you're going to see, the debt loads around the world, but especially in the West, just aren't sustainable. So these are long-term debt cycles. And when they start to when the confidence starts to collapse in some of these countries and municipalities, they can't sell their bonds. You're going to see a big panic. You're going to see a big burst in the bond bubble, and people aren't going to want to feel safe in lending money to governments or municipalities. I've been watching that in the muni market in like Illinois bonds for a long time. It happened in Puerto Rico also. Obviously, there's a little bit of the sovereign debt crisis in a few years back here with Greece, and that was just the tip of the iceberg. So I think you're going to see over these next probably inside of 10 years this start to play out. And I think capital is going to, we're going to have to move into a new monetary system. I think digital assets and cryptocurrencies are going to play a big part of that shift. So anyway, this is just some history. So when you guys start to understand this, or you look into this 8.6 cycle count, these are turning points. So what's interesting is, like in 2011, the business cycle turned and you had commodities peak. I can show some examples here. They basically peaked in August and September. The cycle low was in June. I'm going to talk about this chart, actually. This is a little bit more interesting. So the low, I've gone, you can go back and look at the Dow, for example. But the low in 1994 was in April, the bottom to the exact month of the business cycle. And what's up, Stafford? And so I don't like that color. Can you guys see my pen, my drawing? I'm gonna try to cover a bunch of ground, so I don't mean to talk at you. Just I don't want. So this was the low here in 1994. We had the Asian currency crisis, which was really big. It was big capital flows where it was really centered around Asia, Southeast Asia. But that we had the exact high to the day of the business cycle. It was just amazing. July 20th, 1998. And then on this side of this collapse, typically when you have a collapse in confidence on this side of the cycle, that's where a lot of bad things happen. So you had long-term capital management blew up on this side of this wave. The internet.com bubble peaked on this mining turning point, and then stocks actually bottomed again. If you go look at the NASDAQ 2002, there's your low in November. And then we cycled back the other way. And then this turning point, this major turn brought the high in the real estate market. So that's where capital was concentrated, was in real estate, and specifically within the US. And that peaked to the exact month as well. I'll show a chart. And then again, we had nothing but trouble on this side of this wave. So we had a 2008 banking crisis that pretty much everybody experienced. Not everybody. I didn't trade the Asian currency crisis, but I did trade through 2008. Pretty much a front row seat to the banks blowing up. It was just crazy. I mean, 2-year notes were moving 8 points. They barely moved 2 ticks today. But it was just nuts. But I know what it's like to trade a panic. And so that's what happened on this wave. And we had the debt crisis kind of start to begin here in 2009. And actually, real estate bottomed with this exact turning point. So it's important to know that it's not about highs and lows. Otherwise, if everything peaked with the top of the cycle, right, a market wouldn't always go sideways. We wouldn't have, markets that rallied or markets that were in bear markets. But these are turning points. And everything is connected. So when something bottoms with the cycle, the dollar, typically commodities peaked, the dollar kind of bottomed around that same time. And so these are just examples of big picture cycles. So there's the real estate index, again, peaked with the cycle to the exact month. And then you'll see the low was absolutely nailed it there in April 2009 on that cycle low too. So lots of examples of this. I do want to talk about 1929. This was pretty cool. You can go back and I looked at the data, and this was the Dow during the Roaring 20s. And if you look closely, this is the rhythm to these markets and these cycles play out. So the breakout happened on this bottom with the ECM. Called the economic confidence model. That's the business cycle. And then we rallied for 4 years, peaked pretty much. The Dow peaks exactly with the top of the ECM at 381 in September of 1929. I mean, that's just amazing, guys. If you don't think that you can time markets and that, that these dislocations and these patterns repeat in a fractal manner, they do. I mean, I can prove this. This is just showing that there's an underlying design to the universe. But this is the bottom, 1934, market based. And then if you notice, this was a wall concept that I teach here, and the market crashed and then bounced about halfway and failed. And that happened on the turn in 1937. And this is when the debt crisis really picked up in Europe and capital came overseas, just like I think it's going to play out again here. And we had a big rally in the dollar, and that was all in the 30s. But then the Dow bottomed here in 1942 at the bottom of the cycle, and then went on another rally into the top of the ECM, went sideways. And then the next turning point, major turning point, you finally had the breakout. And then the market absolutely exploded in the 50s. You had real growth in the 50s. So anyways, that's kind of what we do. We're big cycle guys, and this is why our model works well. You know, when you get into cycles, you start to realize that pi is the perfect cycle. And what's interesting about 8.6 years is if you take pi times 1,000, it's 3,141 days. That's the number of days in the 8.6 year cycle. And then there's other derivatives of pi. If you take well, I don't know, I could go on and on, but even if you look at the precession of the Earth's axis, the equinox is 25,800 years, and that's basically 8.6 times 3 is 25.8. There you go. So lots of examples of that in nature. We like to focus mostly on these kind of this wave formation that you can see in a sine and cosine functions, and those are all, you have pi in these calculations also. So there's a geometry and an underlying structure, not just a geometry that you learn in school, but also to space and time, and that's what we really focus on. So I guess let's just get into this add and reduce methods. Does anybody have any questions on anything? That's just a little background. I think that's fascinating. Okay. So when we trade around the cycles and the trend. But then we also, there's 3 pillars to our model that I teach. One of them is analysis. The other is execution. And then the third pillar is risk. So as a trader, you got to put everything together. It's not one indicator. It's not 2 indicators. It's not, this particular chart. It's none of that stuff. You got to put it all together. You have to have a trading plan. You got to know how to correctly identify a trend. You have to have an understanding of cycles. Once you understand cycles, your consistency really goes up. But then not only that, you can have the analysis right, but if you don't know how to work a position, your results are going to be pretty poor. You're going to be too early, too heavy, just a little bit too soon. You won't be able to stay with the position. You'll stop out right at the time when you should be adding and being more aggressive. You'll have problems exiting where you're either cutting your winners too short, you're not letting them run, or you're not taking profits and you're being greedy, and you got to kind of put it all together, and that's what we work on in the training, where I teach you how to identify a trend correctly. I teach you about the cycles. There's lots of different cycles, but the way we use them. And then execution, there's probably 7 or 8 setups that we look for on the charts. I sometimes talk about them in our videos. There's swing line setups, topping tail takeouts, bullish engulfing patterns. Those are all actionable items on the chart that you can take advantage of. And then you can add, get aggressive, put your stop below the low. You can be very precise in your trading like that. So bidding and offering and something also, that's all on the execution side. And then on the risk side, that's where we get into position sizing and adding and reducing. Every big trader is an adder. So a lot of new traders come into, especially into crypto markets, and they tend to want to just plunge in at one price and get out at one price. They don't really scale in. They don't really have a concept of scaling out and then letting them, what I call the market, take you out, which is using correct trailing stop methods. But inside between entering a trade and exiting a trade, there's opportunities to do what I call adding and reducing. And when you start your trade, let me try to make sense of this crazy mess that I drew. When you start your trade, when you think about a cycle, we'll consider this on the short side. There's a time to go contrarian, and then there's a time to stay with the trend. Some traders are like, I only trade with the trend, and I get that because that's where you want to be most of the time. But there is opportunity where you want to start to go a little bit contrarian before the market turns, and that's where you can really pick up the most gains, because a lot of times before you get the MACD or you get some of these other kind of lagging trend indicators, you've already missed a good part of the move. And so I used to struggle with that. I always tried to figure out a way to, what's the best way to trade contrarian, or should you just trade the trend, and the answer is never all or none. You got to do a little bit of both, but you do want to trade with the trend about 80% of the time. And so what you can do when you start to get this add and reduce method down is, before the cycle turns, you can go contrarian. You just want to be light with your size. So on pretty much every trade, you should have only 1, 2, 3, 4 lots, maybe. Basically 1 to 4 entries that you allow to go against you in a contrarian fashion before you start adding to your play. In other words, you don't want to just be adding and add. Well, you think the turn's going to come and it doesn't, and you add more. Oh, you think the turn's going to come more and it doesn't, then you add more, and you get heavier and heavier and heavier, and you're trying to average in, and that's how you end up getting a move that goes against you. And that's how people really blow up on big moves like that. So what you want to do is start with only a few lots, which means your risk is only so much. So what I was trying to draw here is, like, if this is the chart and you know maybe on a higher time frame that there's a high up here, that as long as the market's below that high, you're going to start fading this move in anticipation of a turn. And that's okay. That's perfectly good. That's kind of what you want to do. But you want to keep the risk small in the beginning, and then let the market prove to you that the cycle is rolling over and that the trend's changing. And then you want to get aggressive, and then you want to add into the direction of the move. That way, when you are right, you're right in a bigger fashion. And then the times that you don't get the turn, or even if you're trading with the trend and it's not going in your favor, you're not heavy when you're wrong. That's a simple rule to do. So what I'm trying to show on this chart is that idea that, okay, I'll give it 1, 2, maybe 3, maybe 4 small lots. And just for example, let's say each one of these lots is 100. It could be 100 shares, it could be 100 contracts, it could be whatever. But so let's say you do 100 here. It moves up against you, you short another 100, you move up against you some more, you short another 100. Well, now you've got 300 on. It starts to roll in your favor. You add another 100 on maybe like a swing line sell setup. You add another 100. Now you're short 400. So, basically, if the market doesn't roll over and you were to trade up here and go above this area that you identified as where your risk is, the most you're going to lose is from wherever your average cost is in this process of, if you sold here, if you sold here, you sold here, you sold here, your average would be right about here. You know that your risk is about 400 on whatever this distance is, right? 400 lots all the way back to this high. If you get above there, you stop out. So you know what your risk is, you embrace it, and then the key is you want to try to add in the direction of your winners. So then what I'm showing here is what we call the TMS. I teach my traders that's how we correctly identify the trend. But when that starts to break, there's an opportunity to add more on those breaks. And then typically there's an initial move down that you can cover some. And then that first pullback is really usually the juicy one that you want to be aggressive on. And so you start with 4 lots, you break, and at this point, maybe when you break, you add another 4 lots. So now you're short 8 lots, right? If it collapses in your favor, it gets a little bit oversold on like a 1 minute or a 5 minute chart. If we're day trading, for example, then I would come out of some, I'd take some profits here. Maybe then you're only short, maybe you cover 3, and now you're only short 6 lots. I'm just looking at some of your guys' questions. Are you guys following with me? Is this good? Should I keep going? You guys are with me? All right. Okay. So this is, you're starting to see, this is the adding and reducing. So we start small, putting your toes in the water, just being light, being patient. All right. In this example, I actually have 5 lots on, but you guys get the point. So if I sell another 4 on the break, now I'm starting to get more aggressive. And typically you're going to have a cycle that's rolling over also that's confirming, hey, looks like we're on the right side of this cycle on the way back down. Now is the time to get more aggressive. You don't want to be aggressive here on the left-hand side. You want to be aggressive on the right-hand side of the cycle. So as I start to break trend, and if I have a cycle that's rolling over, typically we use a stochastic, and that'll cross and roll over. All right, so that starts to happen on a higher time frame. Boom, now I'm getting more aggressive. So I'm short 8. Okay, it's moving in my favor. I cover some. Now I'm only short 6. And then as you bounce back up, this is where you can start to get more aggressive. And so boom, as it comes back up, maybe now I'm shorting 3 lots on the way back up. And then I hit it with another 6. And then if it goes higher, I short it with another 10. And at that point, after a drop from here to here, I can be more confident that this next move up is going to be more than likely met with a subsequent other move back down without exceeding this high. That's where your risk is. So if I start my trade and then it breaks and I start to get aggressive and I take some profit, and then on that next pullback, I call it sitting through the first pullback, I can get aggressive, and I know as long as we bounce all the way back up this wall, the edge is that it continues and we do get another move back this way. And then I know where my risk is up here. And then so you just trade it around like this, adding and reducing. Adding to your short, it moves away from you. I'm reducing, covering, taking profit. As it comes back up, I'm adding. But all the while, I want to keep a core piece. Even if I'm day trading, I want to keep some of these lots. You know, if I was short 8 here, and then I covered some, and then I'm short 6, and then I reshort, and I end up being short 10 back on this bounce up here. On these moves down, if I end up covering like half of my position, I'm keeping 5 lots in my pocket for the bigger cycle, for like an entire 30-minute cycle or an entire 15-minute cycle, and I'm holding those lots for the bigger move. And then so I'm writing those pieces all the while I'm adding, and then I'm reducing, because they're reducing your risk when you're covering, right? And then I'm adding, I'm increasing my risk, I'm shorting more, and then I'm covering. It comes back up, I'm adding, and then I'm still riding this position with some trailing stop out methods, etc. So what I try to show is on the size chart, you're starting your size small, and that way when you're wrong small. Your losers are small. And then when it breaks, you want to start to increase your size. And then there are usually at the point when you have a cycle turn and you have a 5-minute and a 15-minute chart start to all be bearish and moving in the same direction. About in the middle of the trade, you should have most of your size. And then by the time the cycle is about 50%, a lot of times you can use a 50 on the stochastic. And if you get through 50, then you want to start coming out of your size. And that's what this is. I'm trying to show that you're taking your size down towards the end of this cycle and you're taking profit. I'm trying to show here what your profit cushion looks like. Because when I start shorting here, and then the market moves in my favor, my average cost, when I start to cover, my average cost basically goes through the roof, where the market I get at this nice profit cushion because I've already realized profits, that the market would have to come all the way back really high for me to to have a losing trade. So anyway, that's the key, is then to add. And so when you're wrong, I might be wrong on 4 lots, but man, when I'm right and the trend moves in our favor, your winners are going to be much bigger. I mean, I'm short. If I lose here, like I just said, it's on 4 lots. But when I'm short 8 lots here and I cover, and then I'm short 10 lots and I cover, and then I'm short 5 again and I cover, and then I'm short 5 again and I cover, and I'm short 5 again and I cover. I mean, I basically, when I lose 4 lots. When I win, I'm winning on, 20 lots. And that's a big thing in getting your risk reward ratios, where, it's one thing to have consistency, but it's another thing also to have your winners instead of being, some people like to shoot for a risk reward of like 3 to 1 if you read certain trading books. Well, when you add and reduce, you can get your risk reward to like 30 to 1. If I lose on 4 lots. When I win on 20. That's 5 to 1 right there. But you'll start to see that you can get 20 times some of these when you're adding into the direction of your play. And all the big traders are adders. They're wanting to add to their position. You get into risk rewards of 20 to 1. And the typical, hey, enter in 1 lot, and then what's your target? I have 2 upside targets. That type of trading gives you these results. When you begin to learn to add and reduce and trade around a core position, I can have a core position on the long term of like Bitcoin, or I can have a core position on the 5-minute day trade on Ethereum or on the euro. Core position is just holding a core piece for the whole cycle, and then adding, getting heavier, and then coming out of something, getting heavier, coming out of something. Jason was asking 5, 10, and 30-minute and 1 hour stochastic RSI look bearish, but the daily doesn't. What do you do in that situation? Well, I have a concept that I teach about runways. And the idea is that when you're day trading, you want to try to capture a full 15-minute or 30-minute cycle. Like if you're playing it short. If you come into a trend and you're lower than the cycle, or if you don't have any concept of the cycle, a lot of times you're going to end up shorting the low because you don't have this concept of time. You see that the trend's bearish, but you missed a lot of the move. So if all you have is a trend, you get in the trend, but you're basically getting in at the bottom of the cycle. So a daily, like you asked, the daily stochastic is great for core trading and swing trades, because when I have a daily cycle, when that cycle gets low, like it just was on the euro, I can show you guys an example on the euro. I know that to back off and bring down my core position, because I know there's a good chance we're going to have a rally, 3 to 5 day rally or a several week rally. And then you want to start your core position bigger back up on the other side of the cycle. Let me switch over to a chart. So there might even be one here so like on Apple here, I just have the Apple chart up. I bought some puts up here at 180 a couple days ago. I took half of those off today. They're up like 80%. But this daily cycle is low down here. And the daily cycle is high up here. I knew, the weekly cycle was low down here on the lows. I was selling puts at 150. A lot of because of that cycle and that part of that timing. But the euro example, here's this last move up in the dollar, down in the euro. The daily cycle was high up here, and we covered a lot yesterday because this daily cycle was low. Did the same thing back here. You can trade the euro versus the pound, same way. It's been in this nice range for about a year now, and we're testing the top of the range again, but the cycle was low down here. You wanted to be coming out of some of your core position. So I'm light. So you kind of want to look, Jason, the answer is you want to look at all the cycles together, but like the daily and the 4 hour kind of dominates the core trading, and then when I'm day trading, it's the 15-minute and the 30-minute cycles that kind of set up the trade. You guys are talking about Bitcoin. I'm not sure if it shows up in futures. I can look at the cash chart. So here, before I look at Bitcoin, guys, here's an example of me adding and reducing on this Bitcoin move. So kind of I don't know, the right term is a basic trader. A simple trader is just going to say, hey, I identified a signal or a cross or something and say, I'm going to buy here. And then I have a target, and a target. And I hate target trading because it completely ignores how price gets to a target. Because you could grind slowly to a target, or you could go vertical in a short fashion and reach a target. When you target trade, you ignore how price moves or how price gets there. But you'll find out soon enough that you set a target, and then you're all you're doing is hoping that it hits. And sometimes let's say your target was right here, and then the market comes just shy of your target and then collapses. Like, you just completely miss at that point. And it's tough to just pick one arbitrary price point and at one exact point in time and think that you're going to be right. There's such low odds of that. There's other strategies of taking profit that are better, like when you move to a new high or when you create angle and distance. If something goes vertical, you got to be taking profit because it just can't sustain that before you get another ebb and flow back. So here's an example I'm buying, but I'm buying light because we're high within the cycle. You're still very extended from here, which is where you're going to get the higher lows that you want to be aggressive on. But I can still take some profit here, buy a little bit back, buy a little bit more, and then get aggressive down here. And so you can see I was buying here, I was taking off into this move here, which was probably like a several hour bounce. All right, and then we got this push, we were coming out of some, waiting for the cycle, boom, right back in, taking some off into that high. I could have added back here, I'm not sure what happened there, and then taking some off. But so by doing this, instead of just saying, well, I bought some and then I sold, like I bought here and I sold, you only get one move of, let's put some percentages on here. You get one move that's like, it's still a great trade. That's a 200% move. But when you add and reduce, man, there's a lot more you can compound because you can start to do, there's that move, then there's, this move here, quick 20%, you buy back, there's another, you add, there's another 40% there, you buy back again. You can do this stuff inside of a 5-minute chart. We do it all the time when we're day trading. I'm in and out on the 1 minute, just, so you're peeling out 26% gain, 40% gain, 72% gain inside of what some people just experience as just one trade. Yeah. So that's a little bit about add and reduce. We work a lot on our size. Size is big. So anyway, guys, hopefully some of you are kind of interested in the model, and I'll just share some results like that some of our traders are having. Let me see if I can bring that up. So, like, this was one of my guys when he just started right out of the gates. Well, this was his comment. My first full week of trading, JRM method, intraday only, and results are terrific. I traded about 1/10 his normal size just to get comfortable, which is good. You're starting a new process. But man, he's like, it's the consistency that gets him excited. I want to get more consistent in my trading. The bigger dollars will follow later. He owned one tiny loser all week. He's just saying that was ridiculous. And I got one. I just want to see if I got his results here. Yeah. All right. So there, look at all like green. That's just amazing consistency. He's trading the euro, pound versus the yen, cable. This isn't just one winning trade. This is applying several different pairs. I mean, that's high level trading right there. It's just his first full week after I taught him this stuff, put it all together. So that's what's possible, guys. I mean, I love trading because it's one of the activities on this planet that offers you freedom like nothing else. I mean, you can trade anywhere in the world, whenever you want. I haven't taken a paycheck in over a decade. Everything is just pulling money out of the markets. And this is one of my old schedules. This is what's possible, guys. Just learning to day trade. $40,000 months, $20,000 months. This is when I was trading treasuries. So the results are there. Before I talk about rhythm and what we're building out, did I share that? Hold on a second. Oh, shoot. Sorry, guys, 1 second. My screen sharing dropped. You guys, we can talk Bitcoin in a second. You guys are talking prices, or you want to add? I don't know if I showed this. I'm trying to show here just what's possible so people know. I mean, this is what consistent high level trading looks like. So I'm willing to help some of you guys get there. The coaching, and then again, paying for the model. This is the goal. That's some of my capital market stuff. So for those of you who want to get started with us, just go to jenkinsrm.com. All our education and trading, I get a lot of questions. Was it just crypto, or can I apply it to other markets? Can I trade futures with it? I mean, yeah, absolutely. Any market, any time frame. That's what's great about the model. We want to be, as traders or investors, you want to just go wherever the opportunity is. Sometimes it's going to be in commodities. Sometimes it's going to be in bonds. Sometimes it's going to be in currencies. It's just obviously, these are just bull and bear market cycles. So it works. And that's what's great too, guys, is when you own this model and you get these skills, you have them the rest of your life. So it's only $2,000 to learn this whole course. It's 9 hours of video. I've number 300 hours of training I've done. I've trained hundreds and hundreds of traders. I've taken guys that, one of the last guys I taught the treasury business to played soccer at Ohio State. He was gonna leave the business. He was struggling. He was in sales, and he just was ready to give up on Wall Street. And he was a sharp kid. He had the right winning attitude. Obviously, he was an athlete. I said, I need another trader. I'll teach you if you're willing to learn. Taught him the whole how treasuries trade. It's a whole new language you have to learn. Things trade in 8s and 30 seconds, and prices and yields and different maturities. It's a whole different. It's much more difficult than just equity trading or stocks. But he's making 6 figures now. He's on his own, independent. I've trained several guys like that, and I have traders that don't even have the background, that are top surgeons in the UK that we've trained. One of the top opera singers out of Italy I've taught. He's one of my most consistent traders right now. But guys, don't shy away. If this is something you're interested in, I would just encourage you to do it. I paid 12 grand to learn how to trade Forex, and I paid for a course that was like literally just taught me 3 techniques. But those 3 techniques I ended up, iterating on and making those techniques better. They ended up becoming part of my model. And I taught some of those techniques and included that in the process of me building my model and process. And those little concepts and that investment I made early on helped us make millions. We'd sit down, I'd trade with the swaps trader at Citi, and he would have $1 million mornings trading that stuff. So for $2,000, guys, I would just, you're not going to get high level training like that probably anywhere else. And then on the coaching side, that's where we really work on the process. And it's one thing to learn on the video. It's another thing when you get inside a trade and you have risk on, so trading together is where we really work on that stuff. The traders get to see how to work a position, what it looks like to add and reduce, all that good stuff. So I guess that's that. You guys want to talk about Bitcoin? You want me to tell you rhythms? I'll let you guys just kind of explore rhythm a little bit on your own. We're in the private sale rounds right now. So if you are interested in potentially even investing, or it depends on your situation. We haven't gone public yet with our project, so it's a small, tight group, but we can have those conversations also. So you can message us. That's something we got to talk over the phone about, what type of deal or what you can offer. But there's, for a select few, we're still open to that. Anyway, so you can talk to us about that in our chat room. But here's our white paper, pitch decks here. We're trying to take all these concepts that I worked with people on and the institutional side, and then independent traders, is, when you watch Fidelity or these Thinkorswim or TD commercials, just having a trading platform is not it. That's one part of it, but you need to have people helping people make calls. I saw what 2007 looked like for retail investors at Schwab before I moved over to fixed income, and I saw doctors, lawyers, I saw guys lose literally millions of dollars, half of their net worth in the late stages of 2007, being long stuff like Google, and some of the housing stocks were on fire, and nobody helps them with the timing, saying, hey, this is rolling over, you're gonna need to be going to cash up here. Instead, people are calling in, buying Google, and Schwab doesn't give them advice. They just say, hey, yeah, diversify. It's not good enough. Like, people get crushed when these markets roll over, and Wall Street blows people up every business cycle. So, and it's obviously a big issue in crypto too. You guys can look at the Google search Bitcoin and look at the Google trends. It follows the price. When the price is exploding, everybody rushes into the market and buys their first cryptocurrency at 18,000, and then it collapses on them, and you got to have a timing, you got to have a process. So that's what we want to do with Rhythm, is get the market right, provide great analysis, research. We'll have a media channel with inside Rhythm. It'll be just a one-stop shop for high-level trading. But then obviously we're going to be building out the technology where we have the charting system and the desktop platform and the mobile. There's no mobile trading right now. But we also want to get away from the custodial model. We're starting Block Edge Capital, which is a digital asset management firm. So for those people that want us to invest in cryptocurrencies for them and manage their money, that's fine. There's a place for that. That's a passive custodial model. But there's some people that want to be active traders, and at the end of the day, they want their own crypto in their own wallet. So we're developing technology called Bring Your Own Wallet, where when you trade through our platform, we send out a buy alert. You can get it right on your phone. You swipe yes, I want to participate in the trade. You can set up that, hey, I only want to risk 5 Ether per one of your guys' signal. That's all done via smart contracts. We execute the trade via, again, the blockchain. Then we send the coin right to your wallet, and it doesn't sit on an exchange. You don't have to, you don't have to do like we do now, or you got to log into 5 different exchanges, make a trade, move it back off into your wallet. It's just a whole disjointed process. So you guys can check out rhythm.network if you want more on that. You guys, a couple of you were asking about Bitcoin. Not a lot of movement today. This has been the slowest I've seen crypto for sure. It's just a down cycle, and the energy is it's just a resting period. I still think though, if we can get above 12,000, that energy is going to start to pick up again. I think some capitals are going to start to chase, but that's what we need to see, is a high above. We need to see some higher highs here on the intermediate term. What were you guys asking about? So 10,200, 10,300 area. Santiago, I'm not sure your time frame, partner. Pi basically capped the market the last 2 times up, and now we are starting to get through it. You can see how this 200 starting to roll. You see, guys, how that's starting to curl. That's showing you the same thing, that the trend is trying to turn back up since being in a downtrend, for most of February here. And we really started to break actually in January. And so when you get in periods like that, these down cycles, there's opportunities to hedge or sell short if you happen to have like a BitMEX account. Those are the times to cut risk, raise cash, and or play it on the short side, and be patient if you are going to decide to buy back in. Hopefully, like we were telling our guys and our subscribers and our customers, that we want to be taking profit in front of 20,000. If you did that, then you have some capital to add back at 12,000, or we held Pi down here at 6. So we just don't have a lot of momentum yet until we get these bands back positive. So the market's close. It's not quite ready. Here's your weekly cycle. This is something that I kept talking about on the way up. It's like, we haven't had a real deep cycle down. All these cycles were ribboning, they were ribboning at the top. And then finally now we got a big down cycle. But from a timing perspective, I do think we're close. I talked about it on this week that we were close to a bottom, and maybe the bottom was in, and now it looks like we're going to cycle back up. And here's that 8.6 count too. 1, 2, 3, 4, 5, 6, 7, 8. So this was the 8th week down. So makes, from a timing perspective, doesn't surprise us at all. You held the bands right where you should have. So these are the places to be buying back into a core position. not up here. You guys on a high on 1 hour, touch pi yesterday. Yeah, the hourly's been pretty good. Yeah, hourly's been pretty good. We can look at Neo real quick, guys, and then I'm actually going to Colorado this weekend, so I gotta start making my way to Miami. Neo. Still like Neo a lot. It's one of our favorite coins. Definitely a core long position. Neo remained in a long-term uptrend even during this whole Bitcoin correction. So still making higher lows. He held the bands. That was a good spot, 109. Daily cycles turning up. We're going to be adding and reducing on. I'm going to be sending out a lot more signals on this stuff. And we've been in since ant shares. It was like 4. Neo BTC. So I mean, I always try to chart the dollar chart if you can, or versus Tether, because that's going to give you a better reflection of what the actual asset is doing versus money. Because the dollars is on the money side of the equation. If you get a big Bitcoin rally, that's obviously going to make your Neo chart look weak. And Neo could be going sideways, but just because Bitcoin's rallying, it looks like your chart's losing money. But you're really not. You're really not losing money because your Neo's flat. It's just that Bitcoin is rallying, and we're not. If you're trying to make dollars, just because Bitcoin's rallying doesn't mean that you're in a bad position. Neo's actually an ad here pretty soon. I like that this 4-hour cycle's low. I'm probably going to add back here. There's an uptrend line here. I'm sure you could draw in there. But versus BTC, like it's helpful to, if you want to, if you have a bigger position on Bitcoin and Bitcoin rallies, you want to take some Bitcoin off, and you say, hey, versus where Bitcoin is versus where Neo is, does it make sense to take some of my BTC position down and add it to the Neo? I get that. I mean, this is a strong chart. Strong chart. And you can see here that we were adding back into our position, coming out of some, adding back, coming out of some. I think you're looking like, yeah, if Bitcoin rallies and then you get Neo that's coming near the lows like this, that's an okay thing. Take a little bit of profit on Bitcoin, add the Neo on the lows back here towards the bands. That's the right thinking. 4 hour. Yeah, it looks pretty good here. I'm probably gonna signal a buy here this afternoon. Anyways, guys, thanks for spending a little bit of time here. I'm going to do some more of these webinars, try to do some more teaching, try to just kind of show you guys what we do, what the model looks like, kind of a peek behind the curtain, and just a feel for what I've been doing for the last 10 years, and is trying to figure out this trading thing and put it together in a way that's really helpful, and have a model and build a process that works. but then you have to have a process and you have to have a model in trading and investing. Otherwise, you're letting the ego dictate. You're just running around buying and making decisions on emotion, and we all know how that ends up. People chase the highs, sell into the lows. So, yeah. All right, good session. I look forward to seeing some new names here. Whether you guys sign up for the training or you want join the group coaching room. If you want to have some conversations about rhythm, like I said, that's welcome for sure. Also, happy to do that, and just shoot me a message in the chat room. You guys have a great weekend. I'm flying back Monday, so we'll be back at it here next week and do some more live sessions. All right. Where's my chat room here? All right, guys. Take care. Have a great weekend. Yeah, you too. You're welcome. All right. Thanks, guys. We'll talk to you.